when you look at the Euro stocks and other markets, which are priced in their local currencies, you put them in dollars, they look similar. All the markets look very similar once you adjust for debasement. So that was interesting to me. Gold, complete almost flat line, really, versus debasement, as it should be, right? That's gold's job. It's to be the stable currency. And once we looked at the world through this lens of the debasement of fiat currency, which again is still contentious, becoming less so nowadays, but it was really contentious when we started it, we realized there's actually only two assets that outperform this. One is tech stocks, and the other is crypto.
Hey guys, welcome to Everyday Finance. Raoul Pal highlights Bitcoin's unparalleled durability and long-term value, reinforcing his conviction that it is the only asset that continuously excels across macroeconomic cycles. He delves deeply into the relationship between cryptocurrency, international markets, and the changing financial system, demonstrating his unwavering devotion to Bitcoin. Marcus Thielen of 10x Research concurs, predicting that Bitcoin may reach $133,000 by September. Many traders were underexposed as a result of the substantial repositioning that occurred after last month's options expiry. Investors may have missed the early portion of the move and are now attempting to catch up, as evidenced by the abrupt rush to purchase call options. With the 10x trend model becoming bullish on June 29th and Bitcoin already hitting a new high of almost $112,000, according to Thielen, there is a 60% chance that Bitcoin will continue to rise. And historical data suggests that it might rise by 20%, putting it close to the anticipated $133,000 target. Anticipated positive CPI report on July 15th and more pro-crypto policy debates in Washington are bullish drivers.
I'll take the big picture part is, look, from our work, we kind of noticed the business cycle structure. We're both business cycle analysts. We've both been looking at them for a long time. It changed after 2008, and it became like a metronome every 4 years. That's only happened once in the past, which was the 1950s and 60s, where it became very, very cyclical. But this is perfectly cyclical. And it got me thinking for a while, what the hell? So many of us didn't understand what happened to asset prices after 2008. We kind of knew quantitative easing was happening. We kind of knew stuff, but we didn't figure it out. And what I suddenly realized is that in 2008, we had a debt jubilee. And in fact, it was just forgiveness on interest. You don't pay interest payments. Remember, we did that over COVID, exactly the same mechanism, no interest payments. So no interest payments allowed every government who had basically, they'd all gone over 100% of GDP in debt. So all economic activity, all economic growth was used to paying of debts. So what they all did was basically restructure their debts between 3 and 5 years, creating an almost perfect 4-year cycle. And then when you look at the debts today, we're in that 4th year now where the final part, the larger part of the debt is due. And what we found is they start injecting liquidity over a period of 3 years, reaching maximum liquidity. That liquidity injection never really gets taken back. Some gets taken back in the bear market years when they're withdrawing liquidity, raising interest rates, trying to slow the economic cycle because of inflation or whatever. But over time, liquidity keeps rising. It's rising at a rate of about 8% a year. And that is, in fact, the debasement rate of fiat currency. And what happens is, and this is the bit that gets contentious with people and they hate it, if you divide an asset by the global liquidity, you get to see whether it's outperformed. The debasement.
People hate that chart.
Oh, they hate it. Yeah, it is the best chart in the world because it then tells you, okay, if I'm to allocate to the S&P 500, I'm basically breaking even versus debasement. So the S&P 500 is not really adding much value. Well, when you look at the Euro stocks and other markets, which are priced in their local currencies, you put them in dollars, they look similar. All the markets look very similar once you adjust for debasement. So that was interesting to me. Gold, complete almost flat line, really, versus debasement, as it should be, right? That's gold's job. It's to be the stable currency. And once we looked at the world through this lens of the debasement of fiat currency, which again is still contentious, becoming less so nowadays, but it was really contentious when we started it, we realized there's actually only two assets that outperform this. One is tech stocks and the other is crypto. And so, just using the liquidity framework, the business cycle framework, the financial conditions framework, it's all suggesting that the probability is, because they need to roll the debt, they're going to have to increase more liquidity, and this is just going to drive assets up strongly. And again, just so people understand why the business cycle matters for the ISM, if you think the ISM has been low, and then go and ask the average American running an average business in an average town, how are you feeling? They say pretty shit, right? People's earnings haven't gone up. Your mortgages are too high, your car payments are too high, etc. So what happens is when the business cycle picks up, there's more disposable income and businesses have more investment income, and that gets driven out the risk curve always. That is what markets do. That is the game. And altcoins, as Julien said, are no different than junk bonds, no different to all the other stuff. It's all the same trade. So it feels like it's all to come for us. We don't see anything that suggests it's not going to happen. And we talked about before, the size of what's happening with global M2 and the dollar moves and stuff like that are very big. So no reason to expect that the move in asset prices is probably more than people expect. And I think the inverse to the business cycle being so low for so long will be the flip side of this cycle will be longer than people expected, because we've got this slight dislocation still working through post-COVID that then extends the business cycle. We don't know yet, but it feels like it's Q2 2024 so far. But if financial conditions keep moving, if they really have done some sort of Mar-a-Lago accord and they get the dollar below 90, okay, then we're going on further. Maybe it's a full bubble cycle then. Maybe we don't get who knows? But, one step at a time. But looks good.
Even though Q3 is usually a sluggish quarter for Bitcoin, the current situation indicates that this quarter might be different. Significant inflows into U.S. spot Bitcoin ETFs, more than tilde. $215 million in a single D indicate robust institutional demand and rekindled confidence. Bitcoin's positive trajectory is being supported by this increase in ETF activity, which may be the catalyst for its next significant rally. Thielen warns that a breakout that characterizes this entire quarter could surprise investors who are keeping a low profile. Bitcoin seems poised to outperform as market volatility stabilizes and macroeconomic fundamentals improve. A favorable climate for digital assets like Bitcoin is being created by the combination of declining inflation, possible interest rate changes, and growing regulatory certainty. The late-positioned trader's desperation highlights the power of this breakout move and creates the conditions for long-term bullish momentum.
And so that completely changed how I allocated and how I understood tech stocks. I was a macro guy. I hated tech stocks. They're always too expensive. You're always a value guy. And I realized none of that made sense in this market. That's why the value investors have been getting killed, is what had happened was all of this. Now, what is driving this? And I think, Julien, if you can just bring up those demographic charts, because these are the absolute most important charts in the world, really to understand. GDP growth is driven by this magic formula, which is debt growth plus population growth plus productivity growth. That's how you drive trend rate of GDP. Now, debt growth's gone to extremists, and now really we're just servicing debts. Basically, GDP keeps falling, and it's falling over time, the trend rate of GDP, because of the magic formula. And Julien, if you can get to the demographics charts, because they're the key ones here. The issue is here, the biggest secular factor in all of markets is this one thing, is the aging of population. And we can see the births rate is falling in the US much faster elsewhere. So that obviously is a function, the labor force participation rate, the size of the workforce, is a function of births, deaths, or the number of people being born, whatever, right? And you hear the phrase demographics are destiny. They are, until the AI and the robots come, which are basically artificial humans. This is the problem that faces us all. But there's a way that they've got around this. If you go to the next chart, is they've increased government debt to offset the declining growth from the population. So part of the magic formula was the debt growth and the other was the population growth. So they've used debt growth. This chart, nobody understands and it's never been copied on X, which is the bizarrest thing because it's the most incredible chart of all, which basically says that all government debt growth is basically a function of labor force participation rate. Now, what's interesting is then, okay, so the debts keep going up. We know the forward look of where the labor force participation rate is going to go, and how it's being funded is liquidity. This is Fed net liquidity. You're probably better to use US total liquidity because that includes the private sector because they're now using the banking sector. So what they're doing basically is debasing currency to pay for the debt. It's as old as the hills. It's as old as the story of economies. It's as old as the story of money. And it's happening at a very pernicious rate of 8%. So you kind of notice it, but don't notice it. But what's happening is asset prices keep going up optically because the currency is getting debased. Even if you look at real estate adjusted by the debasement by liquidity, it's basically a flat line. But wages are a variable input. And so what you find is that wages do not account for this. It's also the same factor that is driving PE ratios that drives everybody nuts. Why are PE ratios going up over time? Because the P goes up because of debasement. The E is a variable and doesn't. So it always goes up in line with debasement. And we've shown that over time too. So this is the really big picture of what we look at. It allowed us to understand there's only two assets to own. And then we got to a further realization, which is, okay, if 97% of all of NASDAQ's price action is driven by debasement. It's the strongest factor we've ever had in any macro regime in history. Okay, great. That makes macro super easy. For crypto, it's 90%. So we've basically got a factor that's so powerful that nothing else matters. Brilliant. So then let's take the NASDAQ. If we've got one force, one economic force, we take the NASDAQ, we divide it by by Bitcoin, it's down 99.97%. So you kind of get one asset allocation only, which is crypto, which is bizarre. In a macro world, we now think you need concentrated portfolios as opposed to diverse portfolios. In fact, diversification just destroys returns now because you've got one clear macro factor. So that's really what we're doing. And then we spend a huge amount of time working on the business cycle and the various components of all of this, how it comes together and where we are in timing of that. Even a step further than that, Felix, is like, what the fuck is an asset at this point? What are markets when you've got AGI, right? What role do we have talking about markets and economies? It's pointless, right? We're just telling stories about, well, there's an actual answer or something knows how to best do it. So what is investing? What is a company at that point? Why do we need them? Why do we need people working for companies? All of these things, everything we take for granted. Don't forget, a corporation is a way of coalescing a bunch of different people, giving it a legal entity to be treated like a human, hence the name corporation. But these agents, they can do most of this. So I don't even know what we need money for, apart from food and stuff. But there is a value exchange. And I think, again, I've been writing about this, that I think it's attention is the currency. As humans, on a human-to-human thing, if you think of love as at the top of the tree, that's hyperattention, singular focused hyperattention. And then you've got attention of, hey, when you've gone with a mate for a drink and you're intensely talking, that's good attention. It feels good. Humans seek that amongst all other things. In fact, that's the most that's why we work for companies and get patted on the back because we've got a promotion. It's attention. So I'm like, okay, maybe we just repivot around the structure of what it means to be a human and drop the money status bits and focus on the attention bit. Maybe that's the signal that social media is telling us, that attention is the currency.
With a recent close above $2,700 for the first time in a month, Ethereum is also gathering fire and appears ready for a run towards the $3,000 mark. Growing institutional interest and a solid technical base support this upward trend. Professional. Investors are bracing for additional upside as open interest in Ethereum futures on the Chicago Mercantile Exchange has risen to $3.27 billion. It's the highest level since February. Simultaneously, Ethereum spot ETFs have had steady inflows for 8 weeks in a row, amassing almost 61,000 ETH, demonstrating strong investor conviction. Bitcoin's waning dominance, which frequently comes before a robust altcoin season, is one of the most striking signs of a larger crypto rotation. Platforms like Swissblock are seeing the next 72 hours as crucial for determining whether Ethereum's breakout will hold and intensify when it breaks out of significant resistance zones. Ethereum may be able to break out of its extended trading range and spark a larger altcoin rally if it can keep up its momentum and break through $3,000, given the increasing popularity of both Bitcoin and Ethereum. The whole cryptocurrency economy appears poised to enter a new, optimistic stage.